the Fed raised interest rates to try to combat inflation, because raising interest rates slows down the flow of money because it increased the cost of money. That means people borrow less, and debt is money. It's actually one of the main ways that the Fed inserts money into the economy. By lowering the cost, more people borrow, and that borrowing creates more spending, and the economy grows. When the economy grows, we have inflation, or the rising in price in goods. Now, inflation sounds like a scary word because when it's high, it is scary. In fact, it can destroy an economy, like we have seen in many economies. But normal inflation at 2 to 3% is actually a good thing. In fact, it's necessary. We want things to go up in price, like our salary. We also want things like the cost of debt to go down, or the impact of that debt to go down in relative terms to the cost of goods and services. The Fed lowered interest rates to put money into the economy because of COVID. They were worried that the economy would shut down, and this worked really well. The economy blew up. That lowered the value of money and made everybody want to invest and spend their money. That's what they do. The problem was it was completely overboard, and it sent inflation through the roof. When the money supply gets so big that there's more money chasing goods and services than there is goods and services, the price of those goods and services skyrocket. This is bad. Nobody likes it when their eggs or bread goes up 30% because they're not getting a 30% increase in their salary. So the Fed needs to slow that down by doing the opposite of what they did during COVID. Raise the cost of money through debt, and that will slow the economy down. Not as much debt goes out, people stop spending as much, and then there's less demand for those goods and services. So the rate of inflation goes down, meaning the prices don't necessarily go down, that's deflation. But the rate at which they go up, that does slow down. And they achieved that. They got it down to just under 3% inflation rate, or that growth rate. So they came out and said, hey, we think we can start to lower the cost of money through interest rates, and the Federal Reserve is going to lower interest rates because then they start to get worried about the economy slowing down too much. A Goldilocks event. They want it to be just right. They don't want there to be too much inflation, but they definitely don't want deflation. That causes depressions, when prices of assets and goods and services tank. That's like when your house was worth $200,000, but then it's only worth $100,000. Not good. So they lowered interest rates and everyone cheered. That means debt's going to get cheaper and we're all going to be able to buy more. But that didn't happen. Instead, the 30-year mortgage went up.